Stocks up in the pre-market, up about 5% right now. What was your take on what you heard? Did it change your rating or your price target for FedEx?
We did take our price target up largely based on the strength of their ground results. There's a lot of talk in the headlines about how FedEx benefited from share take from UPS and the Yellow bankruptcy. But in the aggregate, revenues were pretty weak. Volumes were at best flat in their ground segment. And they really delivered 400 basis points of margin expansion without the volume needed to drive operating leverage. What we think is happening there is they're getting their hands around the cost structure. Inflation and their purchase services line is starting to moderate a little bit. Truck rates are a little bit cheaper, and they're really being able to kind of capture some of the pricing gains and drop that right down to the bottom line. So it was really a great quarter for FedEx.
Yeah, as you mentioned, a really huge beat when it came to margin for the ground division. It was 8.5% a year ago, and then they boosted it above 13% this year. So dramatic improvement, overall margin improvement. Was this also a read on their transformation effort and their cost-cutting effort? Did you believe this gave you more insight, this margin improvement?
Well, it certainly points them in the right direction as far as kind of near-term results. The full-term, longer-term integration of the businesses is a multi-year story. I think what this is right now is the company really focusing on execution ahead of the merger of some of the back office and then the ultimate physical integration, which they are doing a little bit at the margin right now, maybe 20, 25 markets from what we understand in our back channel checks. That's giving them some benefits, but I think that full integration benefit is really kind of a 2 to 3 year story. Right now, I think this is just about the company getting back to basics, putting in some cost controls, and getting their arms around the productivity metrics after what was a very destabilizing COVID period for the company.
All right, I want to ask you about something you seem to minimize a bit. The business wins from UPS during the Teamster negotiations, also the business, I guess, gains from Yellow's bankruptcy. These numbers are pretty eye-popping. 400,000 packages a day from UPS, 5,000 loads from Yellow. You're saying it's not that big of a deal, but I want to ask you this. Do you think it's sustainable? Do you think they hold on to that business long-term?
Well, I think it is a big deal, but at the end of the day, this is a cyclical company, and ground volumes in the aggregate were up maybe 20 basis points. So the volume coming over didn't really drive the outperformance on the margin side. It was really execution and cost control in the ground business. Their cost per piece was down 2%, the first time it's been down in probably 4 or 5 years. And their revenue per piece went up 2%, so that drove your 400 basis points of margin gain. So I don't necessarily think it certainly didn't hurt them. But I think what's more important about the FedEx story here is this is a business where they're taking structural cost out at a very, very weak point in the freight cycle. And what that's going to mean as the freight cycle starts to improve, the bar for operating leverage is going to be even lower. That's going to amplify the upside to earnings in the next freight cycle. And I think it's a really good setup for the stock.
All right, so FedEx says they believe it's going to be a muted holiday season. We're just showing the stock a minute ago. FedEx shares up more than 50% year to date, far outperforming UPS. What's your outlook for the rest of the year when it comes to FedEx's stock and the competition between UPS? And also, do you believe we might see another raise in guidance? A number of analysts are speculating that we could see another raise before the end of this fiscal year.
Yeah, look, management has had some false starts in the past around setting big targets and then having to reset them. I think they're doing the right thing here. They're taking the win. They did raise some of their variable comps, so that's going to offset some of the benefit for the full year. But I think by raising the lower end of the bar or lower end of the guidance range for during the first quarter, that gives them room later in the year to raise. Based on the strength of that ground margin, if they can continue to drive a couple hundred basis points of margin improvement year over year, even in a weaker holiday season, I think you will see that number move up. We took our number up to about 19 and a quarter, which is a full 75 cents ahead of the top end of the range that they laid out. I think they're being conservative. They're being cautious because they don't need to put a big number out there. The results kind of speak for themselves. And I think the quality of that margin gain in ground is what's going to gain investors' attention.